Hello, my name is Sofia Abetova. I'm lecturer of international business, and today we speak about prices, calculations and financing of international trade. The purpose of our lesson is to consider the peculiarities of pricing in international trade, and we will discuss forms of financing. We have only two questions today, is Incoterms, types of prices in international trade, and financing of foreign trade. You can see key concepts on the slide. First question is Incoterms and types of prices in international trade. Okay. In international transaction, one of the important conditions is the price of goods and the value of the contract. The contract typically specifies the unit value of the item and the total amount of contract. Of course, the price may vary depending on the basic term of delivery and the size of the discounts provided. Usually, the base price of the goods includes the cost of packaging and transportation. You can also specify the currency of the price and the payment currency, that is, the currency in which the payment should be made between the seller and the buyer. The contract price can be specified by agreement of the parties in the currency of one of the contracting parties or in the currency of a third country. It doesn't matter, yes? However, any other freely convertible currency and not the one in which the contract price is fixed can be chosen for mutual actual settlements between the parties to the transaction. It should be remembered that Incoterms rules are usually used in international transaction. Okay, what is this? The Incoterms or international commercial terms are a series of predefined commercial terms published by the International Chamber of Commerce, ICC, relating to international commercial law. They are widely used in international commercial transaction or procurement processes, as their use in international sales is encouraged by trade councils, courts and international lawyers. A series of three-letter trade terms related to common contractual sales practices, the Incoterm rules, are intended primarily to clearly communicate the tasks, costs and risks associated with the global or international transportation and delivery of goods. Incoterms inform sales contracts defining respective obligations, costs and risks involved in the delivery of goods from the seller to the buyer, but they do not themselves conclude a contract, determine the price payable, currency or credit terms, govern contract law or define where title to goods transfer. The Incoterm rules are accepted by different governments, legal authorities and practitioners worldwide for the interpretation of most commonly used terms in international trade. They are intended to reduce or remove altogether uncertainty arising from different interpretation of the rules in different countries. As such, they are regularly incorporated into sales contract worldwide. So, there are certain terms that have special meaning within Incoterms. Some of more important ones are delivery. What it means in Incoterms. Delivery is the point in the transaction where the risk of loss or damage of the goods is transferred from the seller to the buyer. Arrival. The point named in the Incoterm to which carriage has been paid. Free, or sometimes franco, they said, yes. Seller has an obligation to deliver the goods to a named place for transfer to a carrier. Carrier, any person who, in a contract of carriage, undertakes to perform or to procure the performance of transport by rail, road, air, sea, inland waterway, or by a combination of such modes. Freight forwarder, a firm that makes or assists the making of shipping arrangements. Terminal, is any place, whether covered or not, such as a dock, warehouse, container yard, road, rail or air cargo terminal. And to clear for export, to file shipper's export declaration and get export permit. Each defined term is a three-letter abbreviation. The first letter indicates the point of transition obligation and risks from the seller to buyer. Group E, the first, you can see it on the slide, yes. So Group E, shipment, transfer or obligations at the place of dispatch or the place of departure. It means that the seller is obliged to provide the goods to the buyer directly at the manufacturer. Its warehouse customs clearance of goods by the seller is not made. The seller is not responsible for loading the goods on the vehicle. Group F, FCA, FAS, FOB, you can see it on the slide, yes. Carriage not paid by seller, main carriage and paid, transfer of obligation from the terminals of departure for the main carriage. The seller undertakes to deliver the goods at the disposal of the carrier, which the buyer hires himself. Group C, main carriage paid by seller, main carriage paid, transfer of obligation at the arrival terminals for the main carriage. The seller must contract for the carriage of the goods, but without accepting the risk of accidental loss or the damage to the goods. You can see, yes, the responsibility of seller on the green. Yeah, okay. Group D, arrival transfer of obligations from the buyer, full delivery. Arrival in English. They said as usual. The seller bears all shipping costs and assumes all risks until the goods are delivered to the destination country. Okay. There are several ways to set and fix contract prices. Firm prices are agreed by the parties and fixed at the conclusion of the contract and are not subject to change. They also refer to the prices prevailing in the case or deliveries under the terms of CIF, FOB or Franco-Fries frontier, including the cost of export packaging, labeling and customs duties. Prices shall be fixed at the time specified between the parties to the contract on the basis of agreed sources, for example, stock quotas, generally recognized competitive materials, catalogs, price lists, etc., and relate to mass commodities. Sliding prices are applied in contracts with long terms of delivery of the large equipment, generally complete on contract terms. These prices may vary due to changes in price indices, the economic condition of production, and the specification of obligations. Price mobile means fixing the value of a unit of production in the contract with the simultaneous reservation to change it in the event of fluctuation in the price level within 2 or 5%. The price discount implies the condition of the foreign trade transaction, which determines the size of the reduction of the base price, taking into account the market conditions, contract terms, delivery volumes, etc. The most common are discounts for quantity depending on the size of the order, make it possible to reduce the price for the buyer who buys a large volume of goods, or maybe special discounts for regular customers. The question number 2 is financing of foreign trade. Medium and long-term financing of foreign trade is usually in the form of bank financing. First one is export financing, is the attraction, securing and use of financial resources for the implementation of an export transaction. Almost all forms of credit used for domestic trade are used in export financing. Export financing can be obtained by conventional or non-conventional methods, and it's provided by banks, non-bank institutions, or maybe government agencies. Short-term financing, generally up to 1 year, in the framework of foreign trade involves financing the periods necessary for the manufacture and or procurement of goods, transportation, sale, and the payment of up to 3 months. The exporter can also get an overdraft of 2 types, national or foreign currency. The probability of obtaining overdraft increases if the exporter has an export credit insurance policy to reduce the risk of losses if the foreign buyer refuses to pay. Working capital financing by way of bills or checks is possible if the exporter sells his goods on the terms of an open account, collection or documentary credit with the acceptance of the roads. At the same time, the customer immediately receives a credit or payment for its export debts, although the bank reserves the right to recourse to the customer in case of refusal of payment by the foreign buyer. The exporter who regularly sells goods abroad can obtain a credit line with a renewable limit. The bank will take into account all the exporter's bills up to the maximum credit limit for any time specified by the contract. The advantage of this method of financing is its relatively low cost. This is due to the fact that the bank processes on a massive scale promissory notes payable by different foreign customers. Many exporters is one country. The exporter can also negotiate with the bank on future forward exchange rates. In future, revenues can be accounted in advance. The disadvantage of this method of financing is its relatively is that the exporter does not whatever the foreign buyer paid him before the refusal of payment becomes obvious, and the bank will take action on the regression. This means that the exporter can continue to ship to customers who may later turn out to be bad buyers. After receiving an accounting source of credit from its bank, the exporter restricts the possibility of obtaining a loan in other ways. Collection bank advances are made to the exporter when the exporter requests the bank to make collection on his behalf. The maximum amount of advance payment is determined on a case-by-case basis, depending on the bank's assessment of the credit risk, and usually does not exceed 80–85% of the amount. Once the sum is paid by the buyer, if the calculation of the exporter, the bank deducts its fee for services, interest for crediting, and the amount of the advance, and returns the difference to the exporter. Banks apply such advances only to reliable foreign buyers, usually regular customers of the exporter. At the same time, the bank usually requires a letter of pledge from the exporter. In this case, although the bank does not become the owner of the bill, it will have the right to recourse to the exporter if the foreigner buyer does not fulfill its obligations under the bill or refuses to pay. Next one is acceptance lines of credit are an agreement under which the bank agrees to accept promissory notes issued by the exporter secured in the form of a trade bill, the term of payment of the trade bill being earlier or coinciding with the maturity of the loan bill accepted by the bank. In this case, the export contract as a rule should be covered by export credit insurance. The advantages of acceptance loans for the bank's customers include the possibility of accounting for promissory notes at a lower interest rate than the rate used to account for trade promissory notes. Therefore, generally accepted loans are cheap sources of short-term financing for the customer, even if the bank charges a fee for acceptance in the provision of this service. Customer advances take place when the exporter agrees to pay a portion of the value of the goods maybe sometimes 100% prior to their actual shipment. Advances can be made both for financing the procurement of raw materials by the exporter and for the production of exported goods, especially when purchasing equipment that requires individual performance, as well as for ensuring the interest of the exporter in case of a violation of the contract by the importer. In addition to the possibilities discussed above, another form of export financing is a buyer's loan through a bank in which the exporter is serviced. Such credit shall be granted by the bank of the seller directly to the buyer or its bank in the amount of the concluded contract. We have non-traditional methods of funding. They include counter-transaction, foreign trade transaction in which the documents are fixed firm obligations of exporters and importers to make a full or partially balanced exchange of goods. Counter trade now accounts for 25 to 30% of international trade. In such operations, purchase of goods associated with the obligations under the reception and sales with the obligation to deliver the goods. Payment is often replaced in whole or in part by the transfer of goods and services. UN expert distinguish three main types of international counter-transaction: barter transaction, good for goods, yes, goods for goods, trade compensatory transaction, and industrial compensatory transaction. Clearing agreement is signed between the two states and provides for the exchange of goods between them within a certain period. Payment of the delivered goods is made not in foreign currency and in domestic currency of the state on account of the relevant central bank. The domestic central bank makes settlements with the central bank of the partner country in clearing currencies, as usual dollars, yes. In turn, the second central bank of the partner country pays the exporter the corresponding amount in the currency of the exporting country. Parallel transaction, unlike barter transaction involving the direct exchange of goods between the exporter and the importer, imply the signing of two contracts that are performed completely independently on each other. Yes, it's very important. At the same time, the contract provides for monetary valuation of the delivered goods. Next one is pre-purchase. Pre-purchase implies that an offsetting transaction and equivalent to the supply agreement as two separate contracts. First, equivalent goods are purchased from the importing country by the exporter. The exporter involved in such a transaction undertakes to purchase the importer's goods for an amount representing a specified pre-negotiated percentage of its own supplies. At the same time, the original export contract sets out the terms and amount of the purchase. Payments under the contract are made simultaneously. The exporter may transfer the purchase of goods from the importer to a third party, another country, maybe another enterprises. Buyback transaction involving cash payments, but the exporter undertakes to purchase the goods from the importer, and the purchased goods are produced by the importer using the goods purchased from the exporter. The increase in interest is taken by trade on the system of displeat, based on the signing of deals on counter obligation. These transactions come from international counter aid, but its modern conditions are widely used in national markets or in any particular territory. The basis of such transaction, the interest of the seller in the expansion of trade in goods and services, which is the possibility of restriction of shortage of money resulting from purchase of the product and in filling him in connection with the sale of goods and services. It is very simple, yes, you buy from me and I buy from you. Thank you for your attention. Bye.